Happy Friday, everybody. Mike Sorrentino here, and got a little bit of a hodgepodge agenda today. Talk a little bit about the Fed meeting, which was boring, but sometimes as you'll see, boring is good. And a couple other random subjects that are, to be honest, somewhat unrelated, but worth talking through just to kind of refresh our investment theses on a couple different areas. Love this quote from famous Scottish author George MacDonald. Work is not always required. There is such thing as sacred idleness. So what that basically translates to is sometimes the best thing to do is nothing at all. And that's a tough thing to do in investing, right? Because you feel like in most industries and most goals in life, the harder you work at something in terms of actual physical labor, right? The faster you build a house, the quicker you clean your room, whatever it might be, typically the better the outcome to some degree. A lot of times when it comes to investing, the best thing to do is literally nothing at all. You know, that's tough because sometimes you're looking at your portfolios and say, hey, I haven't seen a lot of trades lately. What's going on? What's my money manager doing? What's my financial advisor doing? They're not doing anything. I'm not seeing trades. Oftentimes, the best thing to do is to not trade. Right? And it's not to say that a lot of times money managers are sitting on their hands doing nothing. It's a constant update, making sure that everything makes sense, making sure that your investment thesis is still intact. There's always work underneath the scenes, but it doesn't necessarily drive to action. And the reason why I'm using this quote this week is because in many ways, that's what the Fed has been doing for the last 5 sessions that they've met, their last 5 meetings. They came out this week and they said, we're doing nothing at all. And the market loved that response. I'll show you how. This is a chart of the S&P 500 on Wednesday. Take a wild guess when the Fed released their meeting, their policy decision. Right about there. As you can see, the market spiked right around 2 p.m. Eastern. That's when the data hits the wire, or the news hits the wire. And because markets move so quickly these days, that information got incorporated in almost immediately. So why did investors get super excited about the Fed doing nothing? Well, there are a couple of reasons. One, obviously they're not raising interest rates any higher. That's a good thing for the stock market. I think the second reason why is because of not necessarily their decision to do nothing, but rather their expectations going forward. They still have told the world they expect to cut interest rates 3 times this year. They plan to start that sometime in the June timeframe. If you look at the betting markets or where the traders place their bets on what the Fed's going to move, it's about a 74% chance that the Fed is going to cut in the June meeting. Now, those odds are almost never right. I'll just warn you there. But it gives some indication of what's priced into the market. If you look across other central banks across the world, 2 other big things happened this week. Swiss cut their rates, but Japan, more importantly, I think in many ways, removed their zero interest rate policy for the first time in a very, very long time. Or I say zero interest rate, negative rates. They actually had negative rates in the 10-year government bond. So we're seeing some big shifts in activity in other central banks, but not necessarily ours. And I think investors were very happy to see that the Fed still expects to do what they keep telling the world they want to do, which is to cut rates sometime later this year. So if that happens, that should be good for stocks, okay? But at the same time, maybe not so good for other asset classes like cash. You get your bank CD at 5 or 5.5% right now. If the Fed starts cutting rates, that rate will move very quickly in a negative direction. Again, what that will do is if rates come down on cash, investors holding cash might not be happy with the new rates. That might incentivize them to take a little bit more risk in the bond market, even the stock market. And that's the reason why we think stocks will probably rally. Moving on, like I said, a hodgepodge of different subjects today. I found this chart to be very, very interesting. I found it on X or Twitter, whatever you want to call it these days. This is a chart of Bitcoin in the orange. That's the orange. That bluish line is the triple levered Qs. Now let me explain to you what that is. Now the Qs, the QQQ, is an ETF that comprises or that represents the NASDAQ 100. It's basically a proxy for the NASDAQ index. Very tech heavy, very growthy, and very exciting to watch. There are ETFs out there called levered ETFs. What they do is they take on leverage to amplify returns on a daily basis. So what this blue line basically represents is an ETF that if the NASDAQ went up 1% in one day, it would go up 3%. Now these ETFs, I cannot stress to you enough, be very, very careful about owning them. Read the instruction manual. These do not work the way most investors think if you hold them for longer than one day, okay? So that's my disclaimer there. All right, we do not recommend levered ETFs in almost any circumstances whatsoever. But what they can provide a lot of times is some insight into the behavior of traders. If you look here, a lot of times people, first of all, the correlation or the relationship between a triple levered high tech index or high growth index relative to Bitcoin is eerily similar, and it goes back several years. So when you think about people out there calling Bitcoin something new, it's transformational. It's going to replace currencies. It's going to change the world. Okay, that might be fine. I'm not smart enough to debate that question, but this is something I would put back in that argument, saying, well, how do you explain this then? How do you explain Bitcoin tracking probably the most speculative ETF that I can think of right now, a triple levered NASDAQ 100 ETF? How do you explain that? Because to me, this type of relationship tells me that Bitcoin is purely speculative. And I'm not saying there's something wrong with that. I'm not saying you can't make money in a speculative vehicle, all right? That's fine. But as we talked about many times, if you want to own Bitcoin or any other digital currency, just know what you're getting yourself into. These, particularly Bitcoin, has seen 4 or 5 drops greater than 80% of its value over the past 5 or 6 years, maybe 10 years. I forgot what it is at this point. My point, though, is that you got to be willing to take that ride. Now, that being said, if you look at the long-term returns of Bitcoin, they more than justify the volatility. Even with these massive drawdowns, the returns have been absolutely massive on a risk-adjusted basis. But again, I found this to be very interesting. Bitcoin, for all intents and purposes right now, is being traded like a highly levered tech ETF. So just know what you're getting yourself into. I want to move on and talk a little bit about a completely different subject, and this is one that admittedly I've been a major bear on for 2 decades now, and that's the oil and gas industry, energy industry. It's been a conflicting bear stance because on the one hand, I look at the U.S. energy revolution and say, this is one of the greatest things that has ever happened to our country. Rewind the clock 30 or 40 years ago, if you remember when OPEC would meet, and those meetings would be televised on TV, they were major deals because OPEC controlled the world market for oil. We as the U.S. were heavily reliant upon Middle East help and their Middle East oil. And we saw what happened when we got into skirmishes with the Middle East and the impact on our economy. Then in the early 2000s, they came out with this technology here called fracking. And it was this idea of, could we pull out oil and gas? Well, initially, I think it started with gas and then oil. Could we pull it out of the ground in a more effective manner? Could we do it using technology to pull this stuff out of the ground better? You know, prior to 2005, pulling oil out of the ground required rigs. It required people, we used to call them roughnecks. They would go on these rigs and they were working these rigs for 2-3 weeks at a time and they get off. And it was a really nasty industry from the perspective of it was very dangerous, very labor intensive and whatnot. Today, this is an industry that is run by MIT engineers sitting in air-conditioned labs in Houston, pressing buttons on a keyboard to pull the oil out of the ground. And it has made this industry far more efficient. We'll talk about that in just a second. My point here is that the U.S. is now producing more oil than any other country has in history. Think about that. Saudi Arabia, think about Venezuela, all these oil-rich nations. The United States is number one yet again. I cannot stress to you the importance of being energy independent as a country going forward. All right? It's like we're also food independent. These two are huge. We don't rely on anybody for anything. Now, yes, we do import oil. There's no question about it. But we do that for other reasons. If we had to, we could rely solely on the supplies here in the United States and do so in a manner that could last us for several decades. If you think that to see how important this really is, look what's been going on in Eastern Europe since the Russia war with Ukraine. The concerns they've had over food, the concerns they've had over energy. Right? We don't have those same risks going forward, and those are table stakes when it comes to building a place that provides the entrepreneurship and innovation to drive returns going forward in an economy. And this is exciting stuff. In fact, when you think about energy independence, we're actually a major exporter of natural gas. So natural gas is a very interesting commodity. When you think about oil, you can drill oil out of the ground anywhere in the world, put it in a barrel, ship it around. It's very easy to transport. It's very commoditized in the sense that a barrel of oil costs kind of the same anywhere across the world, assuming it's the same type of grade. Okay. Natural gas is different. Natural gas in many parts of the world has very little economic value because it is hard to transport. And it's hard to move around, liquefy, things of that nature. So because of it, in fact, in many parts of the world, they just burn it off. There's no economic value, so they just get rid of it. They let it burn out in the atmosphere when they're drilling for oil. But over the years, technology has increased to where they can liquefy this stuff and then transport it like they can with oil. But because natural gas is very regional, because it's still hard to transport in many instances, natural gas in the United States costs dramatically different than it does in Japan. All right, it's a lot cheaper here. But because we're able to pull more of the product out of the ground, the gas out of the ground, and move it, we've now become a major exporter of natural gas. And in many ways, what we're seeing here is one that's great for the United States and great for exporters here in the U.S. It's great for our economy. But what I think it can do over time is somewhat level the playing field in terms of the cost of natural gas across the world. And that's going to have profound implications for investment returns, not just here, but also in the international markets. So it's something we're watching very closely. But at the end of the day, I mentioned earlier that I'm torn because I've been the biggest bear. Now, I'm talking like I'm the biggest bull right now. I'm talking about how great everything is here in terms of the energy sector in the United States. The reason why I have been massively underweight this sector is because until recently, very recently, this sector has been a very difficult one to invest in because of the attitudes around the CEOs and the executives that ran these fracking companies and these drilling companies. It was a raise capital, dilute shareholders, burn a couple capitals, chase cycles, right? So if energy goes up, start drilling like crazy. And what happened when they started drilling, they flooded the market with supply, and they had no discipline in terms of how they ran their businesses. Zero discipline. And it was very difficult to make money. And we've seen these cycles so many times. And if you look at the returns from XLE, which is the energy ETF, they've been not that great relative to the rest of the S&P 500 over the last 20 years. But what we're starting to see now, finally, after multiple decades, is some discipline in this sector. We're starting. This is a chart of the number of operational rigs over time, over the last, call it 10 years. We saw a spike going into 10 and to 12. This is what I'm talking about, that time where, look, this changed the future for our country for the better. There's zero debate about that. But this is also when these operators and these drillers just flooded the market. They raised a bunch of capital, they destroyed shareholder value, flooded the market with supply, and then we went into that kind of oil, that oil winter type kind of situation we went in 2015, and then we kind of stabilized since then. And what we're seeing now is some discipline. The number of rigs are coming down, but yet the output is going up. What does that tell me? At a utilization perspective, we're pulling more product out of the ground with less resources. Our utilization is going up. That's what I like to see as an investor. So this is a space that we're looking at very closely, not just from the traditional oil and gas perspective, but also from clean energy as well. I'll leave you with a fun fact on this point. Solar energy in most markets, or many markets rather, in the United States right now is cheaper than natural gas. I could not have told you that 5 years ago. And that's a very, very big deal going forward for further and continued energy independence for our country. I wrote this week about stock splits. I'll be very quick about this. What I call a high-class problem. Chipotle, okay, whether you like the food or not doesn't matter. What I will tell you is that for the past 20 years, this company, maybe longer than 30 years now, this company has consistently had lines out of the door at lunchtime every single day in most markets, most locations. There's something about their product and their model that they have been able to sell to customers, and they do so by raising their prices consistently and increasing their margins. And because of that, as you can see, their stock has exploded over the past several years. Now, this becomes a challenge and a high-class problem for that matter, for executives, because Chipotle's management would like to reward their employees for working so hard and helping their share price go up. But it's hard to bonus stock shares to employees when one share of stock is $3,000, okay? So a lot of times what companies will do is split their stock. All right, Google and Amazon did this 2 years ago. They did big splits because their stocks got to this size and they wanted to bring the share price down, okay? So when a stock splits, let's say they did a 2-for-1 split. If your stock is worth $1,000, the splitting of the stock, it increases the number of shares, it doubles the shares, and it cuts the price by half, okay? Let's do some simple math. If I've got 1,000 shares and my stock price is 1,000, that means my market cap is $1 million. If I double my share count from 1,000 to 2,000 and cut my price from 1,000 to 500, I'm still at a market cap of $1 million. My point here is that when you split your stock, there's zero change to the economic value of that stock. All we're doing is lowering the share price. Chipotle this week announced that they were doing a stock split, a 50-to-1 stock split. That means if I have 1 share of Chipotle stock in my account, after they split, I will now have 50. I'll have 49 additional shares. But that's going to bring the price from 3,000 down substantially. Again, no change in economic value, just the price of the stock is coming down. All right, and there's a couple reasons why this is helpful. All right, again, management has said that they want to bonus out their employees in stock, and I think that's a great idea. Okay, wonderful. But also, when the price of the stock comes down, it makes it easier to trade. More investors can buy that stock, and they can sell it. And when you see more activity in a stock, more trading activity, what that actually does is that lowers the transaction cost of buying and selling stock. Now, I'm not talking about the commission you pay to your broker. Okay, most brokers these days don't even charge commissions on stock trades. What I'm talking about is the bid-ask spread. What is the spread between buying and selling a stock? The more volume, the more trading volume you see in the stock, the tighter the spread between those two, the cheaper to buy and sell. Makes the stock more liquid. And that's a good thing, generally speaking, for markets. It's a good thing for individual stocks. So Chipotle has got a number of reasons why I think they're doing this. I think it's a good idea. And if you look in the S&P 500, there's a number of stocks that I think are also suited for stock splits. So we'll see. There's a herd mentality that goes on Wall Street. If this ends up being a successful thing for Chipotle, then you might see other companies follow suit. But just remember, stock splits get a lot of media attention, but at the end of the day, they create zero economic value for the company. All right, with that, I hope everybody has a good weekend, and we'll talk next time.